The last 5 times this happened, the markets crashed. I'm going to show you why the banks are warning that the biggest crisis signal since the pandemic is about to trip. Plus, tonight's show is brought to you by Avalon GloboCare. You can find them on the NASDAQ and the symbol ALBT, and they're revolutionizing precision diagnostics and clinical laboratory services with their proprietary technology. Now, they just had 2 big announcements, and it could be the catalyst that sends their stock price surging. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, I want to show you there's a lot of little indicators that are starting to trip. You can't see this in the price chart, and then we're going to take a look at that crisis signal that the banks are warning about. It's about to trip. It could send stocks crashing in a major way. Plus, we're going to take a look at the broad markets as we do every Sunday, and I'm going to update on that trade I showed you last week. You're not going to believe it because it's surging higher, and you too can still jump in on that. Now, let's head over to Bloomberg, where we start out with the first warning sign, and that is an ominous sign as sellers are vanishing as U.S. stocks smash records. And this is a good thing, you would think, on the headline, because when sellers disappear, it's setting up for prices to go even higher. But yet, this is a major warning sign that's starting to appear. It has preceded past pullbacks in stocks, with the S&P 500 dropping at least 5% in the last 3 instances, which occurred back in 2020, 2019, and 2016. But the last time before the pandemic happened that we saw this crisis indicator that the banks are worrying about, well, it was back in 2016. So you're starting to see that there's some little things that are popping up here. Now, a 3 to 5% pullback would be a normal occurrence within a bull market. But the problem is, what if this is the beginning of a bear market? And that's exactly what this crisis indicator is starting to warn about. But let's talk about some risk going forward, because right now the biggest one as we kick off earnings season has to do with margins, as Goldman's chief economists think consumers will absorb up to 70% of the direct cost of tariffs. But if companies take more of that, it would represent downside risk to margins. Alternatively, if U.S. companies absorb less of the cost, it would represent upside risk. And right now, that's exactly what investors are believing is going to happen. They think consumers are absorbing all of these price increases, but yet the evidence at the consumer level is they're rejecting them. So it's got to be absorbed somewhere along the supply chain. And as we get into earnings, if we find out that American companies are absorbing this and they're likely to absorb more in the future, it's going to change the direction of the markets in a big way. Because right now, this is exactly what investors are looking at. They think earnings per share growth is going to be the weakest it's been in years, and then they think it's going to surge higher. That's why you're seeing so much money flow into stocks. It's under the belief that the U.S. economy and earnings are going to boom here. Could also be because people like to chase things that are going up in price. But let's talk about price, because we mentioned last week that Bank of America said, look, we think we're about at the peak of this market. Now, they've updated their notes and added some risk to that, as they're now saying their year-end target is 6,300, but hold fast, because we're about 50 points from that now on the S&P, suggesting we're about to see a potential reversal here. Now, what is Bank of America warning about? Well, they say it's hard to identify a positive catalyst for the S&P to continue its meteoric run right now, and that the meat of corporate profits, tech company earnings, are slated to decelerate. And this is a big problem, because one of the issues we're seeing in this crisis indicator is that everybody's concentrated in a small number of stocks, and right now, they're the ones that are at risk at seeing their earnings decelerate. But there's another thing we've been watching, and that's fund manager survey, and particularly the cash level, because when it falls below 4%, and guess what? It just hit 4%. That means expectations of fund managers are there's going to be a soft or no landing. And right now, a greater than 90% of them have a net allocation in their equity portfolio that they're saying is greater than 20% overweight, noting that nothing says, quote, it's a bubble more than price action, ignoring normally reliable trading rules. Greed is always harder to reverse than fear, and we mentioned that this was likely the outcome of the markets. As price went up, it was going to pull everybody back in, not just retail investors who've been pushing this market higher, but the professionals, the hedge funds, the fund managers who went cash or went into short positions. They were going to have to chase this higher. Now they've done that, and there's a further risk, because when we look at retail positioning, they're near all-time highs at a 64% equity holding, this according to Bank of America's data. Again, look at the cash holdings now down to 11%. Not all-time lows, but you can see the risk here is everybody's chasing this market higher, which makes it even more important when we get to this crisis indicator we see at market peaks. Everybody's bought in, and the next thing you know, something changes. And what changes could be earnings going forward, particularly if we see the tariff rate go up and consumers continue to reject higher prices. And the argument is that stock operators should pay a 22x multiple for an asset that benefits from Fed cuts. Keep in mind, it's not going to likely cut at the end of this month. Supportive flows, which are going to start to die down, and the fundamental strength of the largest weight. The problem is that investors are crammed in across the board to the same handful of companies. And this is what happens when you get over concentration risk, is that if something changes in the economy of the markets, next thing you know, price starts to come down, and as people start to sell, it creates exaggerated moves to the downside. And now let's get to that crisis warning, because that's everything to do with market breadth. Now, this is something a lot of investors don't even look at. And it's been a tricky topic of late, and you might remember this is something we talk about every week on our Sunday show, that if price is going up, then breadth needs to be going up as well. Now we're seeing something that has a major implication. And again, it's happened the last 5 times. It led to an all-out market crash. Now, this is what we're seeing here. This is a measure that's saying the percentage that are below their 52-week high. You can see now there's less than 10%. This is a very risky position. You go back, and if we exclude the pandemic, you can look at the last 5 times this happened. We had major market corrections, in some cases an all-out crash. Now we're sitting on one of the largest moves in history. This is the 4th biggest move in market breadth. And again, now the risk level is extremely high, because while we started out the show with this mere maybe 3 to 5% drop in price, which we know investors would flood in and buy, when we look at momentum stocks, and remember, the market is being driven by a small handful of companies, all momentum stocks, what happens is you tend to get double-digit price declines. And this is a data from Goldman Sachs here saying that highly concentrated markets don't necessarily lead to big drawdowns in the S&P. They most always lead to a significant drawdown in the momentum factor, and that means the companies that everybody is crammed into. And again, this is why we look at market breadth each and every week. It's very important. Now let's turn to the S&P 500, because we like to look through every Sunday what's going on across the broad equity, bond, currency, and commodity markets. And then I'm going to show you that trade we put on last week. It's been going higher. I'm going to show you how you can get more of those trades that we put out and take advantage of them. Let's start out by looking at the S&P 500. We're going to first look at the breadth on the 50-day moving average. Right now, about 70% of the S&P is trading above that, but the problem is, look at price. Price has been going up, but breadth has been rolling over to the downside. That means fewer companies are trading over its 50-day moving average as price goes up, and that means a smaller number of companies are driving the tape here. Again, that's one of the big risks you see in over-concentrated markets. A shock hits them, and next thing you know, there's a reversal. We see the similar factor happening around the 200-day moving average, about 62% trading above that, but you notice there's been a gap here, and what you want to see is them moving in tandem. Right now, you're seeing fewer stocks trading above their 200-day moving average. That is an absolutely bearish sign. Now, from a price chart perspective, and let's pull up the S&P 500, we don't really see anything here. It's just saying, look, we're right near all-time highs. We're likely to go higher. We closed over our 6-month volume profile, but again, you come back to market breadth and it tells you there's a lot of risk here. Now, let's take a look at our screens real quick, because there's really nothing that gives us any red flags here, other than you have the RSI cooling off a little bit, the MACD's got a negative cross, but nothing major there. Machines aren't selling here, momentum hasn't flipped, but breadth is really starting to make a move here. Let's flip over to the NASDAQ 100. We see the same thing starting to happen. In fact, there's right now about 70% of the NASDAQ 100 trading above its 50-day moving average, and you can see clearly it's on the decline. In fact, the last time we see that happen, you'll note, again, price was going up, breadth was starting to go down, and then price started to follow. And so there is a big risk here. Let's take a look at the percentage of the NASDAQ trading over its 200-day moving average. It's over 71%. But again, it's the gap that matters here. If price holds up and breadth starts to move to the downside, you're going to likely see price follow here. And again, this is a major risk now because you look back, only 5 times in recent history have we seen this happen. Each time it's led to a major market crash. Let's talk about momentum here because right now the RSI is still running at 66. The MACD's got a negative cross, but that's not a big deal. We note that machine positioning's long here, likely to be still slight buyers, and momentum's long as well. But again, it's the breadth that is the risk. And there's a very clear place we see the risk, and that's in the Russell 2000, where about 75% of it's trading above its 50-day moving average. But again, look at the gap here. You can go back in history and note that breadth was not keeping pace with price, and price came down. And then they moved in tandem together, which was a very bullish indicator. But now look, you see breadth starting to roll over. The same thing with the 200-day moving average. Look back in history here, you can see what happened. They weren't running together. Breadth fell, price went with it. We've noted this gap is going to be an issue unless breadth increase. So far it hasn't. Again, setting up a risk here. Now you note we haven't put on a trade on the small caps, and there's for good reason. I have not been in love with this price chart at all. Let's take a look at IWM because I don't think it's a really good setup here. And when we look at breadth, it just tells you there's so much risk. Now, one thing we were looking for was a close over its 6-month volume profile. The problem is there's been this sell zone right above here, and you can see this is what's called a supply zone. And when it's above your current price target, it means where sellers are at. The risk is it gets into the 6-month volume profile range, finds sellers, and reverses again. This isn't really a trade that I would love to be in right now. If I was, I would definitely want to keep my stop losses tight. Let's take a look at XLF. While momentum is positive still, we note the RSI has been cooling off. MACD still has a positive cross, but probably not for long. We know machine positioning is long on both our fast and slow algorithm. What I think is going to change here in the near-term future. Let's take a look at the price chart of XLF, and you can see what's not to like about this a lot. You get a rally break out of the supply zone, price shoots higher, and then next thing you know, sellers are back. It's coming down as we head into earnings season. Again, the risks here are high that perhaps low interest rates aren't going to be the catalyst that send bank stocks higher. In fact, the risk is if we do head into recession, there's a massive amount of debt. This is what you also see at market peaks. Huge amounts of debt, a slowing economy. Remember, we talk about those delinquency rates rising. Well, it's going to have an impact on the bottom line for a lot of banks. But one thing we do know, remember we talked about this in the other show the other day, when Jamie Dimon is talking about rates going higher, it means that his bank is likely buying the long bond. Let's take a look at the technicals here because seasonality for the long bond, not very good right now. We've got one consecutive daily sell signal on our own Momentum Timer Pro report. We note the machine positioning has backed off a little bit, despite the fact that some investment banks claim the machines were going to buy. But the problem is the price went in the wrong direction. You can see it ran right up into its 100-day moving average, pulled back, could not make its 6-month volume profile. Seasonally, this isn't the right time, but wait about a month and you see the seasonal change start to kick in. Could see it run here up to 93, but keep in touch with the show. We will let you know when the time is changed for the long bond. But something everybody roasted me over, that was gold, and I'm still bearish on gold. But notably, from a momentum perspective, we told our subscribers the signals have tripped here, but we're keeping our stop losses tight. So it is possible we could see gold rally here, but from a price chart perspective, it's just not something I love. Maybe you like gold, maybe you want to trade gold, maybe you believe gold is going to go higher. That is great. I have no problem with that, but what I see in the price chart isn't something I love because right now it's just barely getting a bounce off of its 6-month volume profile. It's not getting a whole lot. What we have seen is sellers up here and not as many buyers. And again, the risk is if it rolls down, closes below its 21-day, its 50-day, and the 6-month volume profile, the downside risk becomes very clear. You're starting to look at the 100-day moving average. So while you may be bullish on gold, and so far I've got that call wrong, I'm not sure I've got it wrong forever. But something I think could be very bearish for gold and that is the dollar. Momentum right now is still negative. The RSI, though, has been picking up at 51. MACD's even got a positive cross. The trend hasn't turned, but when it does, Momentum Time Pro likely to flag that. But as of last week, on the 11th, we put a buy it open to our CTA Timer Pro subscribers. Why did we do that? Because we noted that machine positioning here has shifted. They were starting to be buyers. Let's take a look at this chart, because I think the dollar could be a major wrecking ball for the broad equity market and the commodity market, and we're seeing some small signs we're at a bottom here. Now, what would I expect, or at least what I'd like to see, is a rally into the 6-month volume profile. I'd want to see it rejected, and I want to see price come down and buyers step in again, and then a rally off of there would be extremely bullish in my opinion, but you could see why. The technicals right now, RSI rising, MACD's rising. This is going to get the attention of technical traders. The question is, can they break out of all the people that were selling here? We'll find out soon enough, but a rejection there wouldn't change my dollar bullish view. But how about something that is dollar bullish, and that is our trade on ultra short yen. Here you can see momentum is positive. The RSI is on the way up. MACD's got a positive cross, and our Momentum Timer Pro subscribers right now have a 2.57% gain as of Friday's close. And keep in mind, we give our subscribers stop loss levels, and then we revise them on a regular basis. Let's take a look at this trade on YCS, because the bullish case for this is it just closed over its rising 200-day simple moving average, setting up a potential move higher here. Of course, we'll be raising our stop losses right along the way. But again, if you want to jump in on those trades or future trades that we have, whether it's trading machines or momentum, grab the links in the description below and be sure to use your coupon code for your free 30-day trial. But now let's shift and talk about our sponsor for today's show, Avalon GloboCare. You may remember we featured them on the show before, and again, you can find them on the NASDAQ and the symbol ALBT. And they're a pioneering company revolutionizing precision diagnostics and clinical laboratory services with its proprietary technology that delivers genetics-driven results across a comprehensive range of diagnostic tests. And they just had a couple big announcements. Now, everything you need to know in the pinned comment and description below. Let's take a deeper look at what Avalon GloboCare is up to. And they're a commercial stage company focused on innovative precision diagnostics and clinical laboratory services, founded back in 2016 and uplisted to the NASDAQ in December of 2018. Its core technologies include precision diagnostics, the Keto Air breathalyzer device, nanosensor, and a joint QTY protein design platform with MIT. And Avalon boasts a sustainable reference lab testing infrastructure, having completed over 600,000 tests since its inception, and offers highly profitable out-of-network services alongside a high-volume in-network option for customers. The company also sees strong potential for aggregating small to mid-sized clinical laboratories and owns a 40% membership interest in Laboratory Services MSO, which operates a state-of-the-art testing facility in Costa Mesa, California. And Avalon's volatile organic compound, or VOC-based nanosensors technology includes a breath print point-of-care testing device that utilizes AI algorithms and a database of Vox biomarkers, featuring a single-use sensor cartridge for detecting multiple diseases in a portable format. The Keto Air home use breathalyzer detects and quantifies acetone levels in breath to monitor ketosis, optimizing the ketogenic diet, and is bundled with an AI nutritionist app. Let's take a look at some of the recent press releases, because they've taken a significant step towards its transformative merger with YOOV Group Holding Limited, an innovative AI automation solutions provider, by filing a registration statement with the SEC and positioning investors to capitalize on a dynamic, publicly traded company poised to lead in the AI-driven business optimization. With a merged entry expected to trade under the ticker YOOV, pending stockholder and NASDAQ approval, this presents a compelling opportunity for investors to join a forward-thinking venture at the forefront of technology. And Avalon, through its subsidiary Q&A Distribution, has secured a strategic agreement with QI Diagnostics to co-develop a groundbreaking THC breathalyzer, investing up to $975,000 for a 50% intellectual property rights in technology poised to address the growing need for real-time impaired driving detection. This innovative partnership, formalized back in June, underscores Avalon's commitment to high-potential ventures, offering investors a unique chance to support a company driving advancements in public safety and technology. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.